Market psychology, the emotions. Weirdly, the hardest thing for me to show you because you don't know yet until you've dealt with it. Go back, think about how you dealt with things and then worry about it later on because you can then deal with it. Most people have many bull markets and they always lose money in the first one or two because they make simple mistakes based off human emotion, fear, greed. And then you get exploitation through influencers and other bits and pieces and FOMO and all that. Oh, it's horrible. So I hope that this course will make things tick and click a bit more. But if you enjoy it, please do leave a like. Leave a thanks as well if you so wish to. Comment as always. And enjoy the course. So this course is going to be very, very different to the other two. Learning about investing, fair enough. Learning technical analysis, fair enough. But in this one, you're going to learn more about yourself and you've got to reflect on it. I could show you certain things, I can tell you certain things, but ultimately everyone is different. The more you know about the psychology side of the markets is massively helpful, right? So in this course, you're going to learn the following. The psychology around investing and trading. This is majorly important, by the way. The obvious as well is discovering the differences between what it says on the screen and your brain. You may well be greedy, you may well be fearful, you may not understand what is happening around you, and you may well have some sleepless nights because of it. You may be constantly checking your portfolio. You need to understand the differences between understanding what data is given you and obviously your own emotion. Understanding your own barriers, kind of what I've just alluded to. If you are risk averse, if you are not confident, if you have slight issues with understanding information and how to kind of compile that information, if I can get my words out, it makes it a lot easier once you understand them. How to survive in any market due to controlling your own emotions. This is the bit that everyone falls over on. To understand this, you've got to kind of put yourself in the shoes of a novice investor, and you've also got to try and reflect and journal what you are kind of going through. It makes it much easier once you do that. And understanding how markets actually work based on human emotion around you, why markets move, what happens to the markets in fear. Once you understand you are playing a game against other participants, and understanding that they could be going through the same thing, the idea is to try and beat them. So understanding emotion, there is a high likelihood that you have seen the chart I'm going to reveal in this. You need to understand some of these words. You probably would have seen it and you probably would have experienced it too. We're going to compare the Wall Street cheat chart with Ethereum. So I know it's not very clear, but this is a very, very common cheat sheet. We're probably going to make our own as learning crypto. So you get the first start of it is disbelief, into hope, and then optimism. And then belief, thrill, euphoria, when it becomes a mania. This is the whole start of the entire bull cycle where it goes crazy. We're now at the other side of it. You get complacent, you think it will just carry on going up. Anxiety, denial, panic, capitulation, anger, depression, back into disbelief. Personally, I think we're in the denial stage. I think we are, in time of recording, the 6th of January 2023, denial. I don't think everyone's fully panicked and sold out yet. I don't think we've had the capitulation, and I don't think we've got the anger yet. But that's my personal thought on it. Everyone's different. You can see on the right hand side as well, you've got the simplified version of the market cycle, the peak, the trough, and obviously the recovery, prosperity. But the bottom right indicator of time is a massive thing. And we're going to talk about time quite a lot in this course because I think time is the thing that people forget. And it should be, one of the biggest factors in life, really. Now, this is what the Ethereum chart looks like right now. Me just getting trading view, pressing the print screen button, and off we go. It's very relatable, isn't it, when we flicker back and go, oh, hello. It's crazy when you think about it. So this is why I think we are at the denial stage. I don't think we're fully fell off a cliff just yet. I don't think people are fully angry yet. But we'll see, I might be totally wrong. But in terms of emotion, when you start noticing euphoric vibes, or when NFTs are selling at stupid prices, or stupid celebrities are saying certain things on their Instagram, on their social media, or on live talk shows revealing their Bored Apes, random stuff like that, maybe start to take profit. Certainly as well, if some friends that have been like, why are you in crypto? You're such a weird geek or whatever, I don't know. And all of a sudden your friends are like, I want to buy into crypto. How do I do this? You know that is a time to sell. Another good emotional signal and sign is when Coinbase, for example, or Robinhood goes to the top of the app charts because everyone wants in. So bear that in mind as you look at these charts and when you see the height of where they go to. Buy low, sell high. The emotion is the bit that's behind it that does bring you back down to earth, quite literally. So ignoring the noise is probably the hardest thing to do. Psychologically, it is a vital thing you need to do. For obvious reasons, you may well get caught up in the hype. YouTube is a fine example of this. You need to be aware of it. Really, you do need to be aware of it. You will see stuff on Discord, you'll see stuff on Telegram groups, linking videos, and often when you see it on here, it's often too late. Half the time, obviously, we're seeing now the top AI coins. AI have been pumping for quite a few weeks now, certainly when the time span of what I'm talking about here. But when we look at all the other stuff, it's all the other bits and pieces that could be very, very interesting to see how people get you in, and the noise of good, bad, however you want to look at it, will catch you off guard. So you must do your own analysis, right? Another element as well is obviously the likes of Twitter. Twitter is full of FOMO, full of some really interesting things. Now I've literally just, there you go, retweeted this because this is the sort of stuff that you do not want to get caught up in. Like, look at that. From one point to being the next point within a matter of a couple of, literally a couple of hours, let's be fair here. Not long at all. That is a 30-minute time frame. How can it go from one to another? It is madness, right? So please try not to get caught out in it. And the final thing I want to talk about is the noise of predictions, right? You can obviously do predictions based off the likes of Fibonacci in terms of swings, potential target ranges, support levels, resistance levels, right? A lot of things, I mean, you can look at the 3-month forecast, they're all down. It's very interesting that people will look at these websites. Very often in the Discord groups and stuff, we see these added on. What do you think of this forecast of a coin? And I'm like, I have no idea. Like, it's absolutely monumentally mental to think that you can do this. Now, when you click on it, it's just crazy data analytical kind of stuff in terms of target levels. Some of these prices will be madness. They will be absolutely unbelievable. And you'll be like, oh wow, cool. It's crazy, right? You need to be very, very mindful of predictions and stuff like that. People are expecting some monster levels and they get excited about it. They get totally bamboozled by it. And they're not looking at the obvious. They're not looking at the support levels or the resistance levels. They're just looking at what someone is thinking. Now, content should be absorbed if it's video content, but try not to get caught up in the hype of stuff like this. Stuff like this usually paid for promotions, which is pretty bad unless they're talking about really big, obvious coins. If some influencer has just totally just plonked a video on your doorstep and you've never heard of the coin ever, you gotta shine the red flag. That's all. With regard to fundamental analysis versus technical analysis, what is the difference? Psychologically, you need to know this because you may find that people are on different wavelengths to you as a long-term investor or even a trader. Fundamental analysis is essentially a method and information of research that you are going to be doing to determine, is it a right time to buy this asset? Is it a good asset to buy in terms of what your portfolio needs require? And most importantly, is it legit, right? Weirdly. Now, that's the most important factor. When you are looking at fundamental analysis, you are looking for something as an investment that is going to be safe over a longer period of time versus the opposite of technical analysis, which may be a shorter term play. I want you to keep in your mind the element of time here, because good research is good, right? It can save you a lot of heartache if you've spent a bit of time looking at stuff instead of FOMOing in at things. When you look at the technical analysis side, you're only looking at one variable. With fundamentals, you're looking at multiple bits of information. If you're in the stock market, you look at financial data, you look at dividend scores, all kinds of stuff. If you're in the stock market, ETFs as well, in that regard, you'll look at returns. In crypto, you'll be looking at utility of the token, who's in charge of the token, right? Also, elements around the price in terms of fair value with the market capitalization. Is it diluted, or however you want to look at it, right? That market cap is a huge thing for the fundamentals in crypto, right? So when we're looking at the technical analysis side, you're only looking short term realistically. You are looking at basically the trader element of it. What is the price movement like? What are the indicators showing? Is it viable, such as the volume, the price analysis of it, to go into a trade, right? You're not going to look much at the technical analysis for an investment, right? You will be looking at certain parameters, i.e., is it in an uptrend? Is it at support levels? But in terms of technical analysis, for you to make a short-term decision, that is why you need to be, having the contrast between both of them, because they're very different. You can see this here. You can use them in contrast, but you will get confused if you're on social media, as per the last video, and some people are talking about the fundamentals, and then the next person you go to is talking about the technicals. One person's talking about like the 20-minute time frame, 30-minute time frame, looking for a day trade, and the other person's looking at a long-term investment. So you need to know the difference between both of them, right? Now, do both. If you are going to do research into an asset, do a lot of research, fundamentals, right? Do technical analysis to see, is it undervalued? Is it overvalued? Is it in an uptrend? Is it in a downtrend? What's it doing? Is it the right time to be in? However, technical analysis, if you just want to trade and go onto the likes of Bybit or wherever you want to go onto, and don't care about the coin, you're just looking at what is in front of you, short term, that is totally fine too. So just bear that in mind. You don't have to do research on every single thing you want to do a potential trade on, but ultimately if it's an investment, you should really do both. So the fear and greed index, a massive pivot of what way the market will go in terms of a swing, right? Fear is the obvious. Yeah, greed should be obvious too. So when we look at the market, right, we look at the likes of BTC. You'll have ultimate fear down here where people are getting panicky and scared, and you get absolute huge greed. But you also get greed down here too. Bear that in mind, because people want to buy as low as they possibly can, and they may actually find out they miss it, in terms of what's going to happen, right? They may well miss the dip and be stuck here waiting for it. Now, that isn't a bad thing. We'll come on to that later on, but you don't want to get, hype and all that kind of emotion up here, and you buy the top and it comes back down. So fear and greed is a massive factor, right? This is a digital kind of look at it. It goes off a number of parameters, right? So you got volatility, market momentum and volume, social media, surveys currently paused, but dominance and trends, right? Half the battle with the market is, and this is a fantastic indicator in my opinion, right? If we look over the course of like the last, maximum sort of time period, you can kind of pinpoint where the market has been absolutely flowing with juice, right? Absolute fear and greed has been, identified very, very quickly, and it's perfectly aligned here. Extreme fear, investors are worried, could be a buying opportunity. The opposite is obviously too greedy due to further correction, and guess what? You need to start looking at taking profit. So the market, this is how the entire, in my opinion anyways, the market will move, especially in cryptocurrency, especially in certain speculative stocks as well, right? If everyone's talking about it and it's getting very, very interesting, the likes of Coinbase or Robinhood, whatever, at top of the application stores on your mobile phone device, chances are extreme greed. People are getting greedy. People are starting to jump in certain things. It's getting very, very interesting, right? The opposite to that is obvious, fear. When no one is talking about it, when, or when they do talk about it, it's all bad news, or Bitcoin is now dead, or whatever it may be, right? All this fear and FUD. Problem with that is people then try and get as low as they can, start shorting it, and they get liquidated too. So be mindful. So fear and greed is huge. Emotion, human emotion, we all have it. We all know it. And this is the one thing in this course I cannot teach you, is you as a human. I don't know how much fear you get. I don't know how much greed you will also get, right? You need to work that out for yourself. But one thing I will say, look for the little trigger points. There's lots of them, and they become very, very obvious when you're looking around, especially when you're on YouTube, you're on Twitter, you're seeing stuff on the App Store, you're seeing certain things on TV. Bear that in mind. Okay? Edge. You need one of these to help you basically remove all emotion from what you look at on the screen, what information you consume, because you will start get the emotional situation where you are running away with it, right? So it should be a little bit of a secret to you, but the ability to create an advantage over other market participants. Bear this in mind, that if the market all went the same way, it wouldn't be very good, would it, realistically? So there's all kinds of different caveats to all of this. Remember, time frames, different indicators, different elements around news and information that comes out will create the price to go up or down. The one thing that you need to rely on is obviously probability. You need something that will increase your probability in the market that could last a lifetime from you literally, being able to invest, being able to trade, do whatever the hell you want. And it's all about the information that you take on board with regard to what decision you're then going to make, right? Sounds obvious, but it is a simple process that does require an established strategy. A one that you have built, a one that you have created, and something within that might enable you to be like, okay, I can understand and read this data very, very well without having to worry about it, or a certain type of entry, a certain type of exit every single time will make you money. Well, every single time will increase your probability massively. Mix it up with risk management. It could be something that will make you money for life. Realistically, if you are building a strategy that has something within it that could make things much better and much easier for you, stick with it, it should be fine. And again, don't change. Once you've found it, keep it until it's obviously not working. Probability. A massive word, a massive element to why markets go up and down. It's also how analysis works, right? Once you think about being a trader, you need to think differently, right? And as it says here, open markets want traders to think different, right? You got to think differently too. Different directions, different time frames, different elements around this. Otherwise, the whole entire market will crumble. It'll be boring. I often wonder, will the market change if it's all AI and there's less humans involved? Possibly, yes. Bear that in mind. Discover something that is unique to you, but the element of probability has to be at the front of it, right? If you are looking at a chart and you're thinking, right, there's a support level, how many people are looking at that support level? Probably quite a lot. Are you looking for something more specific? Are you using something more specific? This is the point of it. An edge is something that isn't obvious to everyone, but to you, you can go, get it. I know that. That's something that I'm really looking for to enable me to potentially jump into this potential move. And be bold, but also test if it works, right? Don't do anything daft. Don't use an indicator that 3 people have only used. For example, yes, you've got to go with the crowd, but you've also got to think a little bit differently as well. The whole point of an edge, as I said at the start of this and at the end of this very soon, is it's about removing emotion. Examples of this. So it could be a different type of moving average, for example, something less popular, but actually is very effective. Different types of Fibonacci extensions could also help you for profit taking, something a little bit different, but something that is a genuine level, but isn't widely used. Combo of different indicators. You may want to use different types of indicators and have a combination that 2 things will give you something that is much more easier to follow. Volume. Volume is something that is often looked at and disregarded. I personally don't use it much, but there's a lot of information and data out there in indicating that volume can be a massive help to where you put your orders. Different trading layouts. Inverted. Are you rubbish in a bull market? Are you better in a bear market? Turn your chart upside down. Different types of candle colours. Different types of candle. Different formats of candle. There's all kinds of different metrics to manipulate the brain to make you feel more comfortable. How? Sometimes it's not what you use, it's how you use it. Make sense? If this allows you to see the market more clearly, it's how you put that data in your brain. Said it before not too long ago, literally on one of the courses, can't quite recall when, but there's 1,000 ways to skin a cat. Everyone will be looking at the same bit of data and look at the same information, right? When I was a police officer, it was the same thing. When you're at a crime scene, you are literally taking on witness statements, and they are different accounts of everything that's happened, or everyone that's happened, and it's crazy when you match them all because none of them are the same. It's amazing how the brain works. Increase your win rate with good management, and you will be profitable for a very long time. And as I say, it is not what you're using, sometimes it's how you're using it. And finally, your edge should stop you from being emotional. If it allows you to read the data and it allows you to stop FOMOing or get fear in the market because you're trusting the analysis and you've used good risk management and trade management, you should be absolutely fine. Over-analysis paralysis. This is the thing that I think affected me the most when I was starting out. Too much of everything, literally, right? So, repeating this situation, I know. However, having too many of things or objects or just anything in life, right, is too much for the little brain to handle, especially for me. I don't like mess. I'm a bit of a perfectionist, right? You've probably noticed. Now, if you have too many indicators on your chart, they're going to give you misleading signals. Another obvious one is too many investments. Too much, you're not going to keep up with them, right? The obvious, too much information. What information is it? Is it different opinions? Is it bullish opinions, bearish opinions? And then you've got the macro side of it, the foreign exchange side of it, the stock. Oh my, you get the idea, right? Tools. Do you have too many tools? Are you maximum on TradingView? Do you have the likes of Bookmark or other like tools to give you data? Is it just too much? Is it just crazy amount of data going on multiple markets and you don't know what way is up? And another one is too many watch lists. Random, I know, but if you've got so many watch lists that you can't keep an eye on, well, it's going to get hard work, isn't it? Try this. Reduce the amount of indicators. Kind of obvious, and we do talk about it in the other course, but it's something that majorly changed the game for me. Massively. I used to use a lot. Loads of them. I would happily dig out an old video of me, but no, I'm not going to because it's embarrassing. However, that being said, it majorly helped my life. Keep your analysis simple, because if you're looking at too many things and you're looking for too many objects, yeah, all well and good, utilize an indicator to help you see the data. Look for an edge. But if that means having 5 indicators on your chart and 6 different moving averages and you can't see a candle, there's a slight problem there. Something as well that could be of massive importance is try and keep your influencer circle essentially, or your follower count or whatever on social media relatively low. Don't be following like 5,000 people because you do not know what they're going to come out with. They need to be within your style essentially, right? In my opinion anyways, you know, if they're looking for the same sort of thing as you, it's quite a good little bias check. Don't copy blindly, that's kind of obvious, but some people do. And then what happens is when they start copying people blindly, they overthink when the action's already happened, i.e. they're already in the investment, they're overthinking it, and the emotional side of it comes in. That's not what you want to do. Set some rules on how many active investments you do have. This is huge in my opinion. Try and keep them as manageable as possible. Everyone's different, right? I do this full time. My life will be different to yours. If you have 3 kids, a dog, a cat, a rabbit, you're working 45 hours a week, you've got a 1-hour commute every single day, your time is gone. Your time is precious. And having 1,500 investments on a raft of different coins or whatever that you're in is going to take up a lot of your time. You cannot have that. Why? Kind of obvious, but you need to have a little bit of a routine to enable the information that you need, whether that is looking at indicators, whether that is looking at your investments every single day. A routine is a massive thing, right? Every single morning before I do anything, I open up TradingView. I have a little look to see what is happening. I'm going to make mine even better soon by having a stock watch list so I can check my stocks every day, because the amount that I've got in stocks is slowly growing, right? It is slowly growing, which is nice to see. I've always been a buy and hold and just sit and forget, but because of the potential economic climate that's changing, certainly when we're entering 2023, yeah, it could be I need to keep an eye on it. So it's a massive factor, right? Having less noise and investment information to consume will allow you to focus on future opportunities. Sometimes you will miss things by being too invested in something that you don't need to be in, or you got too much going on and you've kind of missed out on a lot of things, which is not good. You don't want to have that. Something that is kind of obvious as well is to increase your productivity and speed of analysis without overthinking. If you have a simple way of analysing the chart and seeing things and having an edge or whatever it may be, you can speed up time. Because if you've got 6 indicators and you've got to wait for everything to tick off, okay, fair enough, but for me that's a bad way of doing it. Especially if you've got to move stuff, especially if you're on the lower time frame, especially if you've got to change your analysis every single day, you'll get bored of doing it very, very quickly. And be okay with your decisions. If you're overthinking it and you got over-analysis paralysis by just overthinking things, you got to get to the point of I am okay with my decision. And the final bit and the most obvious thing is it's okay if it doesn't go your way. Over-analysis can be, why didn't that work? Why did that indicator fail? What happened? And then you go and change it. Then you're starting the whole routine again and you're looking for a new indicator, you're looking for a new edge, looking for a new thing. It's okay. You will never be 100%. No one will be. It matters for a lot of things. It really, really does. Because understand that nothing is perfect, right? Investing is not about being right or wrong. It's usually about survival. It's about growth. And at the end of the day, you're always going to incur losses. You always will be. It doesn't matter. Regardless of how good you feel you are, the next decision you could make could be terrible. And I say this about social media. I've been right a lot of times. I've been wrong a lot of times. The people that are right at the moment are getting a lot of traction and growing their accounts. But their next call could be stinking. You just don't know. Understand if you overthink things, you'll miss opportunities, and you will. And I've done this a lot. I've thought about certain things in my time in terms of certain economic problems, and I laugh and joke now, but I missed a good couple of, a good chunk of time, which equaled money in terms of entry in 2020, for example, with the COVID crash. I've also missed times of profit taking because I've overthought things. This over-analysis paralysis, it may seem pretty mundane to some people, but if you are overthinking things, it's decision making. It overclouds and overcomplicates everything that you're doing. Don't just copy people. Remember your edge, and this should allow the emotional side to stay away, essentially, right? So if you're copying people and you're overthinking everything and you're going, oh, he's doing it, I'll go into it, and then when you're into it, you're overthinking it because it's going wrong, that's where the problems lie. Remember to be consistent. You cannot have something with 10 indicators all over it and be quick at your analysis and looking at certain things and being able to be, understanding that information quickly. It's impossible. You'll never be able to do that. So, psychological stuff, being overconfident. It's like anything in life. If you're really good at a sport and you get really overconfident, you will try and do different things to try and see if it will actually work. However, when you're playing football or whatever it may be, there's no financial heartache when you try to do something different, right? So it's kind of obvious. The winning problem. Sometimes you need to stick to your rules that you were set. However, some people don't do this, and this is where the problems lie. So always remember, stick to your percentage rules, because if you find yourself doing this, you've got a problem. When you are winning, are you increasing the amount of capital at risk? Possibly. Are you removing stop losses because you think no matter what you touch, it's going to go in the exact direction you want it to go? Are you moving your stop losses thinking, it'll be okay, I'll just edge it down a little bit just to see if it'll just carry on? Bad idea. Are you leaving money within a trade when you shouldn't be, when you should be taking full profit or partial profit at certain points, or you just letting it run thinking it's going to go much higher, much higher, much higher? That's a problem. Are you using no rules? No rules at all. Are you trying to buy high and sell higher? This does work, but it's also very, very risky. So you got to be, very, very mindful of that. In a market like today, it's been pushing up quite significantly, the market. People are trying to buy at resistance, hoping it will just push a little bit higher. Sometimes it doesn't. And the most obvious one is don't do any of the above, right? Are you losing? Because this could also be a massive problem. Are you chasing the losses that you are incurring? Are you increasing the amount of risk to try and make it back? Are you not using, again, any rules? Are you just trying to just make money by just trying to break the rot? Are you forgetting your edge and your strategy, which is often a very, very common element to it? Now, there will always be losses in trading. If you're losing 20 in a row, it's probably not down to the fact of your edge or your strategy. It's probably down to you. Are you wanting to make it back in one trade? Stop. Simple as that. Because you need a rule to enable it to stop you from just falling into an absolute disrepair, basically, because you're going to have problems. If you're losing a number of trades in one day, walk away. Just walk away from that screen for one day. Come back refreshed. Fear and greed will be the driver in the circumstances you need to control. If you're fearful or you're greedy, you will probably incur a lot of losses just due to the generalization of your emotion. Top risk management is required. If you can manage your risk, if you can manage your trades effectively, you should be able to grasp this element anyways, because no one likes to lose. No one likes to make money and lose it all just due to pure ignorance of being overconfident and very much cocky. Be consistent. I cannot describe how obvious this is, but if you are sticking to your percentage rule, if you are consistently doing the same things over and over and it's working, stick with it. If it's not, figure out how to be consistent and stopping it quickly. That will help massively. Simples. Keep the rules. Keep using them. Have them at all costs. Be consistent. And the most obvious, keep your head. So it's okay to stand still in certain situations. Try not to get my words mixed up here. It's very, very important that you wait for certain things, but don't wait too long because you may totally miss out. Let me explain. The fear of missing out. Currently, it is the start of January 2023. The crypto market has done a significant bounce. Kind of expected with the drawdown that we've had, the big drop over the last few months. People are scrambling to get in position, right? But sometimes it's okay just to wait out and see what happens, because sometimes, and I will explain why it's important to do this, you need to wait. For obvious reasons, if you've done the previous course with Fibonacci or with support levels, sometimes you may buy that top. That little wick that you see to the upside may be you. You don't want that. So let's talk about it. When prices do increase massively, it's always going to trigger that inner greed within yourself, right? Always will, always has done, always can. So you got to be wary of that. Sometimes you need to wait for the obvious pullback, okay? But what if your buy is totally wrong because you've just aped right into it? Instead of buying BTC at $16,000 where it was sat there for a while, you now want to buy it at $21,000 because you think it's going to go much higher. This can be outlined for any asset. Now, obviously, it can go higher. This is why I always say, if you're going to have a strategy, buy support. Simple as that, right? Always accumulate at decent levels of support when you feel it's right to do so in terms of undervalued or overvalued situations, right? So, if it is wrong, you got a problem, it's okay to input capital at a later date when it's less risky. What do I mean by that? FOMO may have gone. Support might have been found. It may be less risky because that resistance is flipped into support and it's much easier for you to jump in. If you were going from a 16k Bitcoin to 21k Bitcoin in a matter of 2 days, there might be a big pullback towards $18,000. If you're using leverage or if you're just not cut out for the drawdown in the short term and you see Bitcoin drop quite a significant chunk or your altcoins drop by 20%, you may think it's going to go lower. You will find it much harder. What goes up often pulls back. It is a common saying. And remember, what goes down often bounces back. Always goes back somewhere, right? If you catch the extreme fear and sell into a bounce, ouch. If you're going to go into extreme greed and buy into a pullback, it does hurt. Right side. Are you on the right side of the market, more to the point? Because this is the important factor. The next point is going to go about being on the wrong side. Because if you're on the right side, it's okay. You can wait for that pullback. You can relax. But I've not came to this point yet, but you should always have exposure to the market. The obvious. It's not okay to stand still and do nothing when prices are dropping hard. If you are sitting in a downtrend and you know it's a downtrend, do something about it. Instead of just sitting there, buy support. Instead of just sitting there, maybe take some money off the table and redistribute it at a much later date when the prices have finally bottomed out potentially. If you're just sitting there watching your portfolio going from $100,000 down to like $5,000, it's all down to you, really. So you got to remember, sometimes it's not okay to stand still. Ensure that entries are via pullbacks and via support. I've already mentioned that. So exposure. No, not the exposure you get on your camera, not the exposure that you get put in prison for. Market exposure. Always have exposure to cryptocurrency or any other markets that you are into. With cryptocurrency, it's more of a valid point because it's very volatile. Sometimes in stocks you can hold it out a little bit longer. However, the exposure as well, you have to have exposure to profits. If you're buying low and taking some money off the table, have some stable currency because you can input that somewhere else. You can put it into a new project, you can put it into something else that's kind of doing really well, and you can catch momentum, right? If you don't have any profit, you can't use it, can you? And the obvious, don't go all in or don't go all out. The amount of people that say to me, I'm all out, I'm going to wait for this certain level, it's mad because if that level does not hit, you lose. Just slowly dollar cost average into a level because you're never going to capture the bottoms, you're never going to capture the tops. You've got to be very, very careful of that. So mindset, massively important. It's something that I struggled a lot with when I was starting off. Also with the influx of followers that I got and being transparent as I possibly can. I hate losing and I hate the judgment, and the mindset is huge. Mindset is massive, but it is so relatable in everything that we do in everyday life. Let me explain. So you've got to think a little bit differently here. And also I've got to feel that if you are involved in this course, you're involved in investing, you're kind of already thinking differently as well. Not everyone wants to invest. Not everyone likes to invest. And the most important factor is that sometimes you're discouraged from investing because of failure and risk, which is why school education and the academic kind of portfolio of life can be a bit of a problem, and in my opinion a little bit flawed as well, because whenever we do exams, a failure is bad, but to me failure is good because you learn from the mistakes. You could be a trader for like 5-6 years, make a lot of losses, and all of a sudden it just clicks, and then you are an absolute machine. Those failures will make you a much better person. Throughout our life, we have bad elements that can be related to failure as well. You stop from doing certain things because of failure. You are eliminated from certain situations. You could lose a lot of things due to failure. It's a huge, huge problem that we have, and all of a sudden it could spiral. The obvious is investing and trading. You'll never be 100%. If anyone is marketing 100% returns, put them in the bin, literally. Anything that you can do in life is practice. You probably don't recall the first time you walked, or the first time you were able to properly kick a football, or whatever it may be. It takes practice. It's like riding a bike. You don't come out of the womb being able to ride a bike. It's one of those things. It takes time, and that's a huge important lesson. Understanding that eventually you'll make money due to consistency, due to understanding the market, due to understanding things. Time is a massive factor in the market, and you're going to learn more about time in a bit. But for me, you need to practice. Separation. This is a hard part. So, how you think versus what you do. Sometimes you'll think differently to what you actually do. And this is hugely important. You'll do this in any day life, right? You will literally think about certain things, but you won't do it. You always have those little dreams. I want to do that. But most of the time you don't. It's the same in cryptocurrency. It's the same in investing. It's the same in stock market stuff. You all think about things, but you won't actually go for it, right? It's always that doubt. Learning to accept the risk of any investment or any trade, which means everything from the setup to the entry to the exit, right? You've got to have it all planned out, because if that is already pre-planned, you've got nothing really to lose. If it goes wrong, it goes wrong, right? Which we're going to find out in a second, because without the emotional attachment of fear, you've identified the setup, you've worked out all of your risk, and your mindset is now clear, which won't be affected by the market, because sometimes the market will throw a wobbly. It always does. It's the whole point of it. The market's never 100%. It's about managing it correctly. And the probability side of it, the percentage probability of anything in life, right? Accepting the risk. Don't want to be too doom and gloom, but we are humans. Humans do not live forever. Neither do dogs, neither do cats. You've got to accept the fact that we are, as humans, a ticking time bomb, weirdly. It's the same in investing in a way, because you could literally blow up your whole portfolio in one move. You've got to be somewhat careful, right? Now, accepting that all outcomes, whether that is profit, loss, or break even, is one of the big factors that you've got to do before you start putting in trades. Too many people think the consequences after doing it instead of doing it beforehand, which is kind of the point. You don't think about, I shouldn't have crossed that road as a truck is about to plant you in the head. You've got a problem if that's going to be the situation in life, and you've got to be somewhat careful, and you've got to accept all outcomes, that if you are going to do something in life, there may be a consequence, and that might be losing. Increased success rate due to edges. Your edge, their edge, whatever edge it may be. Whether that is you are playing football, whether that is you are trading or investing or playing a game. Some people will have an edge which will have a bigger probability of winning versus you. You've got to overcome that. Perfection doesn't exist anywhere. Anywhere. And I mean that. No one is perfect. Like, you could be the best at something, but you can have an off day. If you look on Instagram, it's all fake photos anyway. So all that perfection stuff, it's all there to show you. It's all market employ. Now, that's why I have the issues with certain influencers when they just delete their tweets when they're wrong. It's a bad idea to do that. And anything can happen. Anything. If you're an investor or trader, you'll know this. News could come out of nowhere. When the market's in a downtrend and you're riding it down, you've been in a good order for a while, and all of a sudden some news appears. Oh, boom! Hello, where did that come from? Let's talk about the concept of time. This is vitally important and also quite refreshing for people to hear. It does take time. It's not going to happen instantly. And I am proof in the pudding there. I am still very young too, and I'm very excited about what could happen in the future if I get things right. And it could be the same for you as well, right? Let's talk about it in more detail. So time is Huge. It is the only thing in life that I think time's the best thing in life, the best currency in life, let's just say. Because when you work, you are exchanging your time for money. And you want to try and get to a point where you are going to revert that formula, right? This is what investing can allow you to do without much of a skill set, without much of a business idea, without much of other things. You can just sit there and do it, right? Let's talk about it. With time, you get experience, right? So if you've been an investor for 10 years, you have got adequate experience versus someone who's been doing it 10 minutes, who buys something random. You also gain knowledge. And I don't know why that's the other way around, but it is. Just, yeah, it'll be fine. So with the knowledge, obviously experience and knowledge go hand in hand. You need the knowledge first to obviously gain the experience as well. Also, you get understanding. Understanding that things will happen differently. So that's, in my opinion, different to experience, because you could be experienced at your job, but ultimately you could have a real weird curveball of a day and you are understanding why that's happened. And then the most important thing is wealth. So with knowledge comes experience, becomes understanding, becomes wealth. That's the equation. It's a random one, and I think this is a massive thing because you always need to learn first. You then need to practice, and then you need to understand everything that you're doing, and then obviously the wealth, if you're good, should come. Growth with time. Now this is a thing that blew my mind, that you've probably seen compounding interest and stuff like that, and that is a powerful thing. If you are buying into index funds over a period of 10 years, just putting £50, $50, 50 whatever into something, over a course of time, you're going to make money with the value appreciation and all kinds of good stuff with the market. That does happen. That's a proven tactic. But it's also proven here too, because consistency will equal growth. Whether you are at the gym lifting weights, whether you are trying to lose weight or grow confidence in that way, whether that is doing certain things in life, the compound effect is massive in everyday life, right? Growth could also equal wealth, because you are growing your investments. You're buying low, selling high, buying low, selling high, or even buying low, selling high, and rebuying back lower to get even more units, which will equal growth of how much you own. And then wealth could equal freedom. Whether your freedom is to work less hours, to have more time at home with the kids, wherever it may be, it's a good goal to have. If you are working 45, 50 hours a week and you can make enough money to passively live and earn to cut down a day or 2 days without it affecting your lifestyle, that's a big win. Diversify. This is huge as well. And something that I've been doing a lot more of recently. When you're making money, you've got to make it work for you. You've got to put it in other places, make it do things, or even just with the high inflation rates that we've got currently, make it so it doesn't just disappear. Stock index funds are a great way to do this, and it does help. If you've got spare money, put them in an index. Just, even if some of the years are pretty low, over time, it's much better than sitting in your bank or splashing out on a very expensive car or whatever it may be. The obvious as well, in line with that, is dividend stocks. If you know me, or you've been following my content, I do UK dividend stocks too. I currently get about a 7.2% yield on year. Pretty good. 7.2% interest, pretty much, essentially, or dividends back in my portfolio. It's nice. Trade other markets. You may want to trade other markets, you may not want to trade crypto or forex all the time, you may want to trade something else. Mix it up, see how good you are. Every market has a different element, and it's that time understanding what's happening around the whole market. You may think, I know what, I might trade that. Go for it. And obviously, you got property. If you want to buy property, depends on your location, depends on how many headaches you want, but it's there as well. Lifestyle. This is a lifestyle, and this is a thing that I think people fully get involved in, because your lives do change, right? It's not a hobby. When you are doing this, right, it's not like playing tennis or football. You are literally, you are part of it. I'm looking at my left hand side here and I'm looking at the Learning Crypto Discord as I'm talking. There's people that's been around for so long now, 3 to 4 years, that have been in a community who have made amazing wealth over the cycles. They're still here. They love it. You know, it's the whole point. It's a lifestyle. It's something different. You should take it very seriously. If you are wanting to get your time back, if you are wanting to understand how you can make money over time through risk, through management, through everything, right? You want to take it seriously. This is not the thing to do on a little whim, put it that way. It's not like you're going to go and buy a tennis racket and just play once. It's very, very different because you can lose a lot of money. It is one game of Monopoly. That's how I always view this game. Investing is like Monopoly. You are building assets, you are trying to create your wealth and then dominate everyone in the game. You can build wealth by being different to your friends and family. Said it before in previous videos on this course. I've said it before on social media. Everyone is different. People have different risk appetite. People want to do different things but don't do it. It's all about doing it. And just, you know, money is a replaceable thing that you get as a salary if you are working, obviously. If you don't work, don't invest, obviously. But you got to put it somewhere. You got to do something. Some people just spend all their money and just waste it. Some people want to grow it. If you're part of that bracket of growing, it's a good thing to do. It might be worth it. Might not be worth it, but it might be worth it. It's worth experimenting and trying it out. So the final part of this section is sticking to core principles, the basics basically. Keep it super simple because everyone likes to overcomplicate everything. So, investing. You need to do your research first. Before you do anything, you need to figure it out. Do your research. What do you want to buy? Why do you want to buy it? All that kind of good stuff. Then the obvious. You need to buy it as low as you possibly can. Easier said than done, I know. But if you have a plan and you're going with it, it's not a bad thing to kind of think about really and trying to get it as low as you possibly can. It's kind of obvious when they're really high. Then selling it high. Sometimes easier said than done because you want it to carry on going up. You're seeing your entire portfolio just going up and up and up and you're getting quite excited. It does happen. Even myself, I get excited. But you got to remain cool, calm, collected. If you're starting to feel excited, you should probably start looking at selling something. Then you want to try and rebuy low. Now, bear in mind, being on the right side of the market is key here. So maybe don't be too blasé about it. But if you know it's a bull market going into a bear market and you've gonna wait as long as you possibly can. Don't just wait for the absolute floor. If you've noticed that some of your investments are down a decent chunk and you can rebuy back what stock you had or what crypto you had for the, for the profit that you've got and have bucket loads of it, it's pretty cool, right? And the obvious, keep repeating it. Christ. If you know what you're doing, you should be building up your entire portfolio asset over and over and over again, all the time, over and over again. It's a great thing to do, right? Great thing to do. It really does make a big difference because if you started off with, say, 10 Apple stock and within 5 years you've now got 250 through just buying low, selling high, really buying back low, it's pretty cool, right? Trading. Obvious, again. You need to find the setup. Before you even do anything, have a strategy and then find a genuine setup. You need to then find where your stop loss is going to be as per that setup, right? Then you need to calculate your risk percentage for that trade. If it's more risky, yeah, don't risk as much. If it's not that much risk, yeah, you can risk it a bit more if you know what's going to happen, kind of, if that makes sense. Calculate the profit taking zones. Make sure your risk to reward and all that kind of good stuff is calculated correctly. And the final bit of this is manage the trade. Too many people overcomplicate it. They do it in the wrong order and you need to keep it super simple. If you know the setup and if you know where your invalidations are and if you know how much you're risking every single time, it's much easier because your risk reward will look the same every single time and then you're managing the same thing. Sometimes managing is the least amount of management you can do is much easier. So the bigger picture of investing is to hopefully make some money. And this whole section is about profit taking, right? As I've alluded to in the previous course, it is subjective. Everyone has different goals, everyone has a different reason for taking profit, everyone has a different time frame and all that kind of stuff amalgamates into one, right? It's obvious. Now when you look at this BTC chart here, for example, yeah, cool. It's low, right? It's been a much higher. It's not a bad place to look at the bigger picture. However, sometimes you need to take profits too, even on the way up. BTC, cryptocurrency assets are volatile. They also have the elements of rug pulls. If you're buying a dodgy project and you are not secure in the bag, you should be. Because if that project gets, rugged, you're going to lose all your money, right? It's already happened before in previous assets. It's happened with exchanges as well, which is why you always store your money safely. But let's look at BTC, right? The bigger picture is this could go up and make you some more money, right? Looking at the higher time frames, you can see the growth here. Yes, we've had a bit of a push to the upside here, but what if it does drop? What about if it goes lower and you've bought this little top here? What if it does go much higher? If you're buying these lows and you're not taking something off the table, you should be. BTC is not moving much. It's not going to make you life-changing goals, but it's something you should be accumulating, right? Accumulation of units. But let's look at the S&P 500, right? Random example. Index funds, profit taking and all kinds of good stuff. Look at this. This is the S&P 500, the index of the top 500 stocks in the US. Right, accumulation of units and taking profits, rebuying back low and all that kind of good stuff. You could be doing that on multiple assets and putting your money into this and just letting it work for you over time. Not worrying about it, just chilling out with it. If there's opportunity to sell at really obvious peaks, crack on. If not, just hodl, right? So you got different mentalities in different markets. For me, the hodling market of crypto is dangerous because of the cycle booms that it has. You can buy low, you can sell high, you can make mass money. However, bag hodlers for 3-4 years, if you do it at the wrong time, kind of sucks, right? Which is why this section is going to be very, very vital for you to accumulate units and understanding the principle behind it and the psychological element to it. Yes, I know people will be moaning on the screens going, oh, but taxes. No one cares, right? If you're an investor, you should always be paying your taxes anyway. It's totally fine. So do not worry about it. But diversification is key. Taking profits is key. You are an investor now. You are a trader now. Why are you going to keep your money in the crypto market and become liquidity for someone else? You shouldn't be. You should be looking to be able to sell something for profit. Now, a lot of people do say, do not sell your Bitcoin. However, I still kind of agree and disagree. Yes, you should hodl some Bitcoin, but if something blows up, and let's just say this goes to say 100k, random number, I know, but if it does, and you bought all the way down here, and you know that these market cycles change rapidly, and you'll lose all your gains, well, guess what? You should be secure in the bag because wealth is wealth, right? Accumulate it, utilize it somewhere else, and enjoy your life. So this whole section, profit taking, a little bit of a whirlwind for you. So for some reason, profit taking in cryptocurrency is a massive problem. It is a thing that people hate. You get literally bludgeoned on social media. Certainly I do. We're all here to make money, right? Regardless of what you think, it's an investment and trading market. Unless you are a developer, unless you are a part of a project and you are getting paid by said project, you're in it for the tech, right? There's going to be elements where there'll be no social media kind of taboo eventually, like the stock market. No one cares in the stock market if certain people sell. I feel like the narrative of certain words have been given to us via certain educators in the space that is making it hard for people to let go. Diamond hands, for example, the laser eyes, paper hands, all these kind of sayings. Obviously, diamond hands I'm holding, laser eyes 100k Bitcoin sort of thing. Paper hands is obviously the negative side of it. Oh, you got paper hands, why are you so weak? I remember when the market was topping out, and currently I'm watching the market crumble a little bit at the moment. So with regard to this, obviously, in terms of what I was doing in the previous cycle, psychologically, I knew that the race was run because I, not to be big-headed, was already in the market. I already made my money, right? I was already looking at my portfolio thinking, whoa, hold on a minute, this is too much. And when you look at the bigger picture and you start seeing NFTs on, Jimmy Kimmel and, Fallon program, all these big programs in America, massive, monstrous programs, right? And you think to yourself, oh my God, this is mad. The celebrity endorsement of cryptocurrency exchanges, naming rights of exchanges. And then it was just getting crazy and crazy, and it was just spiraling. And then all of a sudden, the price dynamic changed massively. When that new high was created, I was getting at the point of thinking, yeah, I'm going to get out now. And I did. I got out on all this sort of situation here. In this sort of November time, I sold like 20% of my bags. I sold a lot more down here in like December time. A lot more here. Pretty much most of my stuff. And then that was it. I was just riding it out. The key is to survive, and people do get offended because communities of projects get upset. I've been a part of projects and all of a sudden they turn against you and you are hated because you dumped your bags. I'm here to make money. They're an investment. The days of cryptocurrency are long away from it being a settled market. That's the whole point. There will be a hodler market at some point where we can hold a lot of assets and not worry too much about it. Maybe Bitcoin might be the exception here. But when you see in the previous cycle, Ethereum going from $1,400 down to $82, oh my God, why would you want to hodl that all the way to the floor? You don't. Why wouldn't you not sell and rebuy back low, which we will talk about in the next video? The fundamentals are, this is a cyclical market. It's like the NASDAQ, right? Where tech stocks go up, they also come back down. They go back up again, they come back down. This is a very clear and obvious market where it's done this before. Look at this. First one, Mt. Gox crash, right? Obviously all the way down here. Second one, boom. The ICO bubble, right the way down. And obviously this was a lot of Ponzi schemes, right? Didn't make a new high though. This was a lot of Ponzi schemes. Went back down, COVID crash. Boom. Quantitative easing. All that kind of stuff. Hit these kind of levels. Then the Luna blow up, FTX blow up, and now we're down here. This is important why you should take profits and always consolidate your investment, have a solid foundation. Yes, for some people it may not be quick and fun, but for me, to have the assets available and liquid, I would rather have it than not have it, because if you are buying these levels up here and then all of a sudden you are capitals down here, ooh, you can't do much. So please make sure you understand that. And yes, you will be hated for it, but you can cry into your ledger with a lot more money than the people that are hating you. And I know that sounds a bit bad to say that, but the reality is the hate that you will get, and I've understood this quite well, are from people that are probably hurting because you've taken profit and you've done something against the grain. People who go against it a little bit will always make money. That's just the way it is in any financial market. Remember, there's a buyer and a seller for every single transaction here. You want to be able to buy low of someone fearful and be able to sell when someone is getting greedy. So the main idea of growing unit is to focus on the unit itself. So you always have the amount of the asset, and then you also have the value of everything. So for example, if you have 10 BTC, you will have the value of all your 10 BTC, as an example, right? The one thing that people forget is they get all into a muddle and they forget about the obvious. How many BTC can you have? How many BNB, AVAX, Apple, Microsoft, if you sell the appreciation? Now, the way I look at this is like dividend stocks, right? Recently, I've started a dividend portfolio. in UK dividend stocks. I haven't put massive amounts of money in, I'm just building up slowly, which is a good thing, by the way. I held Halfords. Halfords wasn't the greatest for essentially dividends long term, but in a very quick amount of time, it made 65%. That in itself is getting a load of dividends very, very quickly, all as a one-er. If I wanted to go and rebuy back Halfords, I probably can if I wanted to, if I kept that money to the side. I didn't. I put it elsewhere because I wanted less exposure to retail. But my point is, if you can sell something because of the appreciation of a unit in value from when you bought, it's always a positive. Now, a lot of people have that mindset of, right, I'm going to buy BTC, I'm going to hold it forever, right? If you're looking to give horse in the face, sometimes it's a bad thing, because the worst thing that I will always remember from my time as essentially a newer investor back a couple of cycles ago in the start of 2017, 2018 sort of cycle where it all went mental, I wasn't bothered about the drawdown because I felt like I already made it, but I actually hadn't. It comes down quick. When you make quick money quick, you've got to be wary of that because you want to be able to keep it as a foundation. So what do you do? It's all about having a plan. Now, in the next video, I'll talk about having a bit of a plan about the exit strategy, but the principle is simple. There's a couple of ways you can make money. You can obviously stake on the chain, which is totally fine to do so, by the way. However, the best way is always being able to sell something and then rebuy it back low. What do I do? Now, what do I do? It's relatively straightforward. Now, if you keep, and I call them swing bags, you can call it whatever the hell you want, keep something that you have available to you. Now, these could be a percentage, it could be 10%. 90% could be locked in staking as an example, or wallets, right? That 10% you can do whatever the hell you want with. You can sell it low, rebuy it back higher and make a loss, or you can buy low and sell high and make a gain, right? This is the thing you want to focus on, because if you are growing this, you can then put more money away and grow and grow and grow over time if you're obviously good enough. It's all about the risk. Now, this is more of an investment sort of element, but it's all about profit taking, right? Recently, we just had a bit of a push to the upside. You can see that on the chart. It's very, very clear. Fundamentals are telling me that this is still a bear trend. Okay, yeah, of the technicals anyways, in terms of that aspect. Nothing has changed other than the price has moved. Take profits here and rebuy back low. Now, what do I do? What do I do is very, very straightforward. I rebuy back what I sold. Rebuy what I sold. Units, right? So if you sold half a Bitcoin, if you sold half an Ethereum or 10 Polkadot, right? You rebuy it back, but lower than when you sold. Whatever is left over equals profit and extra distribution money if you're in USD. However, if you're selling just the one unit and essentially just, looking to rebuy back lower and you gain an extra 20% of whatever you are risking, sweet, it's more units, right? So there's a hybrid system here where if you have 10% somewhere just laying around and you're able to sell it for a profit, congratulations. If you are thinking longer term and you want to redistribute that back into the market at a lower price than when you sold, it equals more units. Same with this. It is perfect. If you're selling 3 or 4 different things in a market pump, or you'll feel that we're at levels of resistance and you input them again a little bit lower and you get the exact same amount of units that you had, but you've got some leftover profit, even better, because you can either live off that or you can redistribute it into other things or do whatever the hell you want with it, right? It is a good way. So always remember to keep growing. This is why I look at dominance charts. This is why I look at my overall holdings to see how much I've actually got. Is it growing? What's it doing? And over time, if you're adding units, so if you were like buy low, sell high, and you had a load of profits up here, like a load of stable currencies, and like you've like down here and you're thinking, bloody hell, I've like 4 times my bag. If that goes up, even better. Because the next video I'm going to talk about prior planning to stop you from getting overexcited when things do potentially happen. So yeah, This one's a good one. So, something to control your emotions and have a prior plan of action, because a lot of people tend to buy things and then when things go up in value, it's like, oh my god, what do I do? Or they've over-risked, which is not good. So I do two things. I plan my potential exits. These are really useful on assets like Bitcoin, for example, because you can see where prior structure has been. However, if it's a new coin, it's a stab in the dark job here, because you cannot see where it could be going, which is obviously a huge fundamental problem. So if you've got like a brand new asset, you won't have all this history. You'll be like looking into the dark and be like, well, it's rising, where's it going to go? Oh, yeah, oh. It's a bit different, right? So got to be careful. So rule number one, always plan some sort of exit at some point. Not all your bags, but let's just say percentage ratios or whatever you want to call them as, risk reward. If you're a trader, etc., you've always got to take your money out of the market anyways as a trader. But this is more for investing, because if you start buying low and not selling high, then that's where you need to do it. Essentially that's how you make money. That is how you build wealth, by securing the bag. You need to go from unrealized profit, into realized. Okay, it's the most obvious thing. Now, what I tend to do, if I can get my favorites bar up, I tend to look at the obvious. So for example here, look at this juicy level. Why wouldn't you not take some money off the table here if you bought these lows, for example, right? Level of interest, huge interest, it's kind of clear cut. Now, I know people be like, oh, but what if it carries on going? Yeah, if it carries on going, that's why you do not sell all your bag. If you sell a percentage of it, what if, right, we go up to this level and it bounces right off it, right back down again as a bear market rally? That would hurt, right? It would be horrible. It would be disgusting. It'll hurt a lot. And if you've not taken anything from that, you cannot rebuy back low. So always have a plan to sell something at certain points. Now, obviously things could go crazy. You can be looking at trend analysis. You can be buying back on the pullbacks and stuff like that, which would be really, really helpful. But always plan your moves. Have like zones of interest. If you want to use round numbers, you can. It's up to you. But you got to look at the structure. If you go on higher time frames, you can start to see where things are and very, very clearly identify levels of where things have stopped and turned around. Psychological levels. Again, another psychological level up here. There's loads. But that should be obvious to people if you're using support and resistance. Now, the other little trick that I play on my mind is an obvious one, but some people don't like it, and I think it's quite funny. Try and calculate how much your bags will be worth when it goes up again. So you could do it 50% away from all-time high, 25% away from all-time high, at all-time high, or above all-time high. It's up to you. Personally, I like to go just a little bit below all-time high, because not everything will do it. So what I mean by this is, if you get your bags, right, which sounds kind of silly, but if you do the simple maths of units times by the price that you desire, or whatever you want to go as all-time high, whatever it may be, equal profit, or the amount / amount, whatever, right? Now, the reason why I say that is because some people will over risk, right? If you are constantly just putting money in, what if it does go to those levels? You need to have a bit of an idea of how much money you could be making in a couple of years' time if the market does rip up to the upside again and you bought a good solid asset and it does go to those all-time high levels. Because sometimes you will get to certain periods in your life and you'll be like, oh my god, this is crazy. You need to know that it's a lot of money first before it starts happening, because when you start getting carried away with emotion, you are not going to take profit because you want it to go higher and higher, right? Does that make sense? So for all your assets, do the units times by whatever price you want it to kind of be at, roughly, or all-time high levels, or below all-time high levels, or even, as I say, 50% away. So let's just look at, I don't know, Near Protocol for a random example, right? All-time high was $20. What if we're just going to do it from, say, $10, for example, right? 50% away. But if you're putting a load of money in and you bought a load at like $1 or whatever, you've made a lot of money. And you need to kind of see that, hold on a minute, I've made quite a lot of money here. You need to kind of be ready just in case it happens. Because if you're not ready and you're looking at your portfolio, you may want to do something silly. you may not even want to sell it. And sometimes leaving money on the table is the worst thing you can do, because money's money, profit's profit, right? You could be making 50, 60, 70, 80 grand in a very quick short space of time. You could be making hundreds of thousands. It does happen. I know a lot of people that made lots of money very quickly and then lost it because they did not take any profit and they weren't aware of how much they could be making because they didn't do the maths firsthand. You know, you got to look at the obvious picture here. You are investing for a reason, to make money in an asset that you've done research at a price level that you want to buy because you think it's fair value. Why not take the time just to go one step further and see how much it could be worth? And if it does go there, you kind of know what to do. So that's the whole point of it. It's tricking yourself into kind of being a bit more grounded. Because if you look at your portfolio and think, wow, if this all goes tickety-boo, which is very unlikely anyways, but at least if one of them does it, you know exactly what to do. Because if you are looking at something that's made you $50,000, $60,000 from a very, very low outlay, you'd be like, oh my God, why am I not taking profits? Because people at that point will be thinking it's going to go up and up and up and carry on going. So you need to be wary of that.
How to psychologically survive and thrive in a bear market. Now, if this is the first or only course of ours that you've done, you'll realise that this is not Ash's voice. My name is Gaz. I'm analyst for Learning Crypto. Obviously, if you've done the other courses, you will know me from them. So this video probably going to be a fairly lengthy one. And I was going to chop it up into separate videos, but I thought the more I sort of thought about it and went through it, the more I realised actually, if I go through my own personal journey from 2017 and 18 getting into the market to then, you know, my own experience of surviving and then thriving in that 18 sort of 19 bear market, I could then bring the lessons in sort of a real time experience for you, and it just sort of makes sense because you end up going over the same points in the different videos. So brought it to you in one. So I've got a few pointers there on the screen. That's A, for you to take note of, but B, to help me sort of refer back to them as I go through my experience. So we'll go through the points first, and then I'll take you through my journey, so to speak. So surviving and thriving in a bear market. Sticking around and buying in a bear market pays off a big time. I mean, you can just see that by looking at the charts. If you're buying in these lows here, then you're obviously going to get your reward further down the line. So a lot of people get shaken out in bear markets, either through price and or through boredom, and then they end up coming back when it's way too late, hence counter the herd mentality. So we spoke about this in previous courses when we're talking about bull and bear markets. The reason why bull markets explode to the upside is because people come in late, people FOMO, fear of missing out, and they realise, oh my God, this is going much further, and they buy in too late. And then they're the ones that end up suffering in the bear market on the way down. So the herd mentality, everyone wants it when price is up, and no one wants it when price is low. Because everyone wants it when the price is going up because they think it's going to go much further. No one wants it when price is low because they think it's basically going to go to zero. And that is the basic human psychology that you just need to counteract. So what happens, the reason why this rally after 20k got fueled is because literally all the people that got shaken out of the market down here, sold, left the market, whatever, they suddenly saw it on the news or their friend told them on social media. They're like, oh my God, it's back, it's broken its previous highs. I was silly for getting out. I wish I should have stayed in. And so they jump in because they don't want to miss the boat. And the same thing will likely happen years and years down the line whenever we break this sort of 69k or on the way up at 40, 50. All the people that have been shaken out and not bought in the lower areas, they're then going to rush back in, and that's what fuels these bull markets. And it's also what fuels the bear markets, when people who have bought these local tops or the macro tops, we come down, they're losing money, then they get bored and they think, do you know what, I'm out of here. And especially this last leg down in 2018, that was a real kick in the gut. A lot of people just left, cut their losses, got bored down here, and then all of a sudden they're buying back in when prices return. So you need to counter that herd mentality. You want to be buying low and selling high. As simple as it sounds, that is literally what you got to do. So in a bear market, you want to diversify, but don't spread yourself too thin. We'll sort of come on to that a little bit later, but basically what can sometimes happen is you get shiny object syndrome, where you literally want to buy every coin on the market or every good coin, and there's 20, 30, 40 on your watch list. You want a piece of all of them because you're worried in case that you basically want exposure because you think they're all going to go up, they're all going to go to the moon. Likely, yes, they are all gonna rise. So a high tide rises all ships and all that sort of stuff. But ultimately, you need to be able to have a short list. We usually, obviously not financial advice, we usually recommend that you want maybe BTC, ETH, and then maybe 6 altcoins. Of course, this can also translate into stocks, commodities, whatever it is you're investing in. You don't want to be stretched too thin because otherwise your capital just won't. You won't have enough in each investment for it to make a big enough difference. And also, if you look at the next point, keep up to date on investments. If you've got 20, 30 investments, there's no way you can keep up to date on A, price action, B, developments, fundamentals, and stuff like that. So you really want to keep that nice and short. You want to obviously diversify a bit so that you've got exposure to different areas, but not too thin so that you, A, haven't got enough capital to make a difference, and B, that you can actually keep up to date on it all. Next one, have a plan for all scenarios. So, excuse me. Basically, you want to be able to have a plan. This goes for trading as well. You want to think to yourself, right, if things fall through another 50%, what's my plan? Have I got enough capital? Have I committed too much too soon? Likewise, if we do the opposite, if we absolutely rally, then have I put in enough exposure that I'm happy if we may not see these levels again? Or what if we just go sideways for the next 2 years? Have I overcommitted? Have I got enough cash to survive, etc.? Because the phrase you want to remember is that the market can stay irrational longer than you can stay solvent. So the market could literally just do this sideways action for 2 years or so, and if you've put in too much, maybe you're going to struggle, and then you sell too early before you get a rally, something like that. So you want to be able to have a plan for all scenarios, especially if you look at current day here. When we're down in this range, you've got to think to yourself, right, have I got enough exposure if we get a surprise rally up like we did, or have I got enough cash / stables left if we drop another 50%, or as I said before, if we just sideways chop for another year or two, have I got enough outside of crypto to be comfortable? Can I sleep at night, basically, is the thing you got to say to yourself. So you need to have that plan for all scenarios, and having that plan and sticking to it will ease that psychological burden on yourself. And lastly, be patient. We've sort of covered it already in the previous points, but you look at this period of time here, November 2018 all the way through till March 2019, weeks and months of just barely anything, and that's where you don't want to be overexposed and sort of thinking every day, every week, oh god, it needs to do something. You just need to be chilled, relaxed, have a decent amount in, but not too much so you're overexposed, and then you'll reap the rewards. So let's go to what my experience was. If you've done the other course, the technical analysis course, you'll know what my investing journey. You'll sort of know most of this already, but we'll quickly go over it, and then we're also going to go into more detail and talk about how we got through, or how I got through the last bear market and did well out of the last cycle. So as you'll probably already know, I bought in pretty well, got in a good time for Bitcoin. I got in around August, September 2017, bought my first lot of Bitcoin. It was around $3,000 or so. Ironically, I thought I was a bit late to the party because, it had previously been, only just the year before, you're talking hundreds of dollars rather than thousands. Thought it was a bit late. Obviously, I wasn't. I actually got in a really good time. And then we sort of rallied from $3,000 up to $20,000. Thought I was a genius, thought, oh, this is fantastic, got all these profits. And then I made the crazy decision in January 2018 to start investing in altcoins and diversifying. And it's probably one of the worst decisions I possibly could have made, because it was obviously literally right at the pico top of the bull market. And my investments just went down and down and down all through 2018, as you can see. So this is the weekly time frame, obviously. This is the top, and all the way through to December 2018 was all the way down here. So just all of this downside I was buying and buying and buying and buying. Literally just went to zero, and I basically had to start again all the way back in the start of 2019. Had to restart again. So what was my plan? Served myself right. I don't have as much to play with as I did before. As I say, I lost pretty much all my profits and most of what I invested in the last cycle. So I was like, right, pricing needs to start again. What's my plan? I decided I was going to use altcoins to basically increase my Bitcoin stack. So I was going to use altcoins as a vehicle to make Bitcoin. I was going to use the Bitcoin dominance chart, the altcoins versus BTC pairs, and that was my plan going into it. So I had, I think it was around 6 investments, 6 altcoins that I invested in, and obviously spread my money evenly across. Dollar cost averaged into the bear market around sort of end of 2018, start of 2019. And my main one, I should say, it was Matic. But what I'm going to use is ADA as another example. I invested in both Matic and ADA, but ADA's got a really good chart to show you just what a bear market is like. So this is the Kraken chart. This is the weekly. So you got to remember, each one of these candles is an entire week. Now look at this for a bear market price action. So this was the top. We had a little rally here, April 2018, but then from literally, I mean, you're talking July, August 2018, all the way until December 2020. So you are talking a long time. Let's go from where we sort of bottomed out all across here until we started to break out again. You're talking 114 weeks, 798 days. So you're talking, best part of 2 years. Just literally sideways, not doing anything. And this is what we mean by having patience, and buying here is where you're going to get rewarded. So again, having that plan, how long can the market go sideways for me to be still okay and stay solvent? Buying here, you get your rewards, because look at what we got in terms of a rally. So if you were buying all the way through here, let's just take a rough midpoint and take a look at the gains you would have made. That first spike we got, you're talking 2,500%, and then whatever you managed to hold on to right at the peak of the top, you're talking 3,000%, which is obviously an insane return. And then if we look at the ADA BTC, so this was the chart I was trading because I was trying to increase my BTC stash. Again, pretty boring period here, July 2019 all the way through for another year till July 2020 before we saw any decent upside. But again, the rewards were there. If we take a look up to that peak, you're still talking 1,000%, which is obviously like a 10x. So multiplying the amount of Bitcoin I put into that asset by 10 times, which is pretty crazy. And again, if we take a look at Matic, this was my my biggest win. We'll go to the Matic BTC chart because this is what I was trading. This is the chart, obviously current day, but if we zoom in, this was the chart I was trading at the time. So we had a nice big spike here in December 2019, but then look at this, just all sideways chop. These were obviously quite big moves at the time. Obviously nothing now when you zoom out, but I remember this was obviously a pretty rough time. So November, December 2020. So this was when, so we'd obviously had this big breakdown here, which was pretty rough. And then we've got this sideways movement, nothing happening, and then another breakdown. And it was tough, but I stuck to my resolve. And again, the reason I was able to stick with it was because I didn't overexpose myself. I'd evenly exposed, I had even exposure across all the 6 different assets. And again, I wasn't all in on one, so it meant that I was able to ride it out. And we had this breakdown here, and not only was there bad price action, there was a lot of FUD around the team. There was claims that they were scamming people, that they were selling the tokens, all of this sort of stuff. And we broke down to this low, and in fact, ironically, I actually had a buy order right at this low because I had it marked out as a weekly level. As you can see, start of this uptrend. I actually had a buy order at 50 sats, a little bit cut, that didn't get filled, but I was dollar cost averaging all the way down, and then I got my rewards, as you can see. I mean, just an absolutely home run of a rally. We went up something crazy like 10,000% or something like that. As you can see, 10,700%, absolutely crazy. Obviously, I didn't hold all the way up. I sold for an average. I think if we go to the USD chart, I think I sold around sort of between $1.50 $2. I didn't catch this second wind up to $2. Up to $3, but I didn't care. I mean, you look at where I was buying here, just absolutely flatline. You can barely see any movement, but that's again going back to all of the points I said before. I had the patience. I hadn't committed myself too much. I was able to stick with the position. I didn't get shaken out with the FUD or the price action. Had the patience, all that good stuff, and that's the rewards that we got. Now, going back to what I said about having a plan and sticking to it, there was a time where, if we go to the Bitcoin dominance, obviously you'll know this if you've done the technical analysis course, but Bitcoin dominance, when the Bitcoin dominance is low, your portfolio wants to be majoritively Bitcoin, and then when the dominance is high, you want it to be majority altcoins, because as Bitcoin dominance falls, then your altcoin pairs are going to do well against BTC. So there was a time when I think it was this period here, so the summer of 2019, where Bitcoin dominance had this massive run up. At that point, it was very painful to be in altcoins because it was only Bitcoin that was rallying. So Bitcoin was flying off, making really good money, but the altcoins were absolutely suffering, which was tough. And then it happened again here in September 2020 as well. Again, this was where I pretty much was fully exposed, all money in the market, ready to go. And as I say, from September 2020 to December 2020, it was just a Bitcoin only rally. And so the alt BTC pairs were sort of bleeding, and the altcoins in dollar value were stationary, whereas Bitcoin was absolutely flying. And that was a tough time, but that again was where I had to stick to my plan, and know that it's okay, because eventually that money is going to filter back through into alts, and the multiples that I'll make on the alts will more than make up for the lack of action here. And that's exactly what happened. As you can see, from December 2020, we had one of the biggest alts seasons you've ever seen, resulting in dominance coming all the way back down to 40%. So from 75% down to 40%, as I say, from December 2020 to May 21. If we take a look at Matic BTC, again, as you can see, so from May 21, absolutely flying, and then you'll probably see it on the ADA chart as well. So again, May 21, which is about here, April, May 21, absolutely huge rally again. So yeah, final point to finish on is a phrase we like to use quite a lot in learning crypto, which is you never want to be all in the market or all out of the market. So you always want to have some crypto and some stables. Obviously, you change your weighting depending on what the conditions are. So, needless to say, in a bull market, you want to have the majority of your portfolio in the market. In a bear market, you want the majority of your portfolio out the market, slowly transitioning, as I say, dollar cost averaging on the way down, buying key support levels, maybe taking some profits on bear market rallies. But yeah, keeping an eye on what your split is, but always have some in the market and some out. Going back to that point of having a plan for all scenarios, you don't want big rallies like this and you're completely out of the market. Likewise, you don't want to suffer the big declines like I did in 2018, where all my money was in the market and it was just going down and down and down and down. And also one other final point, which I almost forgot about, when it came to the bear market as well, staking, obviously crypto specific, but staking is a really good idea on those assets that you are keen to hold for the long term, and you believe are going to do well in the future. Staking just gives you some free units for literally not doing anything at all. I staked the majority of my 6 assets, Matic and ADA, I certainly did. Matic, again, going back to how much of a big win it was, the other factor to consider with Matic as well, because I was staking Matic all through 2019 and 2020. By the time it came to the time where I was going to start selling my Matic, 10% of my entire sort of bag, if you like, of Matic was free staking rewards. So I literally got an extra 10% for free just by simply staking it. So definitely something to consider if you've got an asset that is stakeable. Obviously, the best way to do it, try and do it on a cold storage facility. Obviously, not your keys, not your crypto, all that good stuff. Try to stay away and avoid staking it on an exchange or any earn protocols or anything like that. Just do it the proper way, do it through a hardware wallet and all that good stuff. So yeah, hopefully this little guide of how to psychologically survive and thrive through a bear market will serve you well. I'm being as honest and transparent as I can about my personal experience. Obviously everyone's is going to be different, and going back to that strategy that I had about using alts to grow your BTC and all that good stuff, it's not necessarily the only way to do it. Of course, there's loads of different ways, like actual strategies in terms of making money in a bear market or a bull market, whichever way suits your style. But in terms of the psychological aspects, I think these are pretty much as good as it gets in terms of the accuracy and things you need to bear in mind when you're going through a bear market. Because as we've said before, it's the psychology that really affects people more than the actual the price and the technicals and all that good stuff. So hope you enjoyed it, hope you found it useful, and hopefully it will get you through your next bear market.